Alright, it's my first video on chart analysis. We're just going to dive right in. So, it's called a candlestick chart. It is no different than a line style chart. And when I say, when I say line style chart, I'm talking about the one you regularly see that looks like this. Obviously, everybody's seen something that looks like that. Indicates prices, or a stock's price history over time. So, right now I want you to know that first of all, these candles insinuate intervals of time. And currently I have this set on a 2-minute chart so I can see what a stock's doing in a short span of time rather than over time or even in a day. This is what it's been doing. Like this section right here is just 4 hours. And the section before this is 4 hours. So it's just an 8-hour span, not even a full day. So, you could also, put these up on higher time spans, so an hour, which will show you what it's been doing through a whole day. But we're not going into that. I'm just going to show you basically how to read a chart, what it means. So, a red candles are two different colors. A red candle is going to insinuate that the price fell during the time the candle shows. And when I say it fell, I'm going to say that it opened it opened higher than it closed at. And when I say it opened higher than it closed at, the opening price is right here. It means it fell all the way down to here in that 2-minute interval. Since I have it set on 2 minutes right here, each of these candles represent 2 minutes. So, obviously with a green candle, it's going to mean that the price rose in that certain time interval, in that 2-minute interval. And when you have a green candle, the opening price is at the bottom and the closing price is at the top because the price rises in that span of time. It opens lower than it closes at. Obviously with a red candle, opening price is right here, it falls, closing price is right here. These wicks are very important to understand on the ends also, as they show us in a red candle's case, the opening price is right here. It shows that the price went up in that certain period of time, but sellers entered the market right here, and it ultimately fell down to right here. And in a green candle's case, you're going to see that it opens right here. It ultimately shot all the way up to here, and then came back down and closed right here. Now there can be wicks on the bottom also, and when there's wicks on the bottom, this insinuates that in the red candle's case, the opening price is right here, closing price is right here, that the price fell all the way down to here, but was driven up before that time interval ended. The 2-minute interval ended. In a green candle's case, right here where it has a wick on the bottom, it's going to insinuate that the price fell during that time, but was driven up by buyers. So, that's good. The bottom of these candles are good examples right here. And this is our first good example of a support line. And a support line is an area of interest. And it's an area where you can tell hold on. A support line is an area that you're able to tell a stock fell to, and then investors, and when I say investors, I'm talking about institutional investors, big investors, investors that are buying with millions of dollars that are able to move the market like this. Mind you, this is not just regular people trading that's moving the market like this. This is big investors, so you want to play by their hand. You want to see how they're moving. So when a price falls down to here, you read it for a little bit. You see these is 2 minutes. So the price stayed around here for about 4 minutes. It respected the support line for about 4 minutes. It shoots up, and then you see it hits this resistance line, and the resistance line shows what area investors thought was a good opportunity to sell at, meaning the highest it was going to go. So when you get up to a resistance line, obviously it's going to fall. It's going to resist. And when you ever have a sell-off or a buyout, after you're going to have consolidation. Consolidation is where the market is choppy and it moves sideways. You don't want to be investing right here. You want to be investing around a either supply zone. And when I say supply because this is where buyers enter the market and there's a supply of it. When I say demand zone, I'm saying that this is an area where there's demand for it and people are selling. So after you exit or enter a supply or demand zone, you can see consolidation. It's not where you want to be trading or buying in at or selling at, because you can never predict what's going to happen after consolidation. Obviously, I mean, when we get more in depth, you'll be able to basically see what's going to happen. But this is not a good area to be investing in, is what I'm trying to say. So within major resistance and support lines, there's also minor resistance and support lines. And when I say that consolidation, I'm saying these are the areas of interest that the consolidation respects. So you see right here, price touches the resistance line right here, falls back down. In the history, we can bank on that price respecting that line again. And right here is a good indicator that it respects both lines. It shot up to here, but then again, it was driven back down by sellers and capped off right here at this minor resistance line. So you see these regardless of whether they're major or minor resistance lines, they're going to be touched more than once, and that's what makes them resistance or support lines. They're going to be touched more than once. So that shows us that if a price falls to this price again in the future, that it's going to be driven up. And obviously we see in the future, just 15 minutes later, the price falls down to here and is driven up. And obviously it's vice versa. When the price reaches this point, it's going to be sold. So you see the price gets up to this resistance line, it's sold. You can bank on it being sold at that in the future. Obviously, comes down, goes back up, touches this line exactly where it hit last time, $1.45, and it's sold off. So this is basically all you need to know when you're learning how to analyze a chart. You need to know two other terms, two very important terms. They're bullish and bearish. And what bullish and bearish mean are that it's your position on the stock, meaning what you think the stock is going to do. If you have a bullish position, you think the price is going to go up. And you can remember this by remembering that a bull, when it goes to attack, it swings its horns up. When a bear goes to attack, it swipes its paws down, meaning it goes down. It's a bearish position. So they're very easy terms to learn. The stock market is not hard to learn at all. It's the only reason it's complicated is because people try to make themselves seem way smart, and they coin all these crazy terms that don't really mean much of anything. They're simple terms that could have been something else, but you just got to bear with the market, and you got to understand this stuff. We're going to have a great dive into this in later videos, but this is a good basis of what you need to know about the market, how to read a chart, what a candlestick chart is, and what it's telling you. I appreciate you.